Hi, Donald Davidoff, co-founder and CEO of Real Estate Business Analytics, here for yet another episode of The People Behind the Performance, where I sit down with key leaders and disruptors to dive into what's really driving the real estate industry's success, the role data plays in it, and tell the stories of the people behind it all. So I'm here today with guest Mike Schall, who's President and Chief Executive Officer of Essex Property Trust. He previously served as the Senior Executive Vice President and COO of the company from 2005 to 2010, during which years he was responsible for strategic planning and management of the company's property operations, redevelopment, and co-investment programs. Long history before that, 1993 to 2005, he was the company's CFO. So he's been with Essex for a long, long time. Obviously then responsible for the organization's financial and administrative matters. Prior to that, he was with Marcus Millichap. He was also the CFO of the company's predecessor, Essex Property Corporation. He was Director of Finance for Churchill International, a technology-oriented venture capital company. And prior to that, 79 to 82, Mike was employed in the audit department of Ernst & Young. That was long enough ago that it was actually known as Ernst & Winnie back then, where he specialized in real estate and financial services. So welcome, Mike.
Donald, it's great to be here with you.
It's wonderful. So let's dive right in. So as you think about the state of the industry today, what's on your mind?
Yeah, it's a great question. I think the industry has done well and over a long period of time, and it now faces some pretty unique challenges that we haven't seen in many years. So if you go back to the early mid-90s when most of us went public, there were 35 to 40 apartment companies that went public during that period of time, and that's consolidated down to somewhere around 7 major players and a few other companies as well. And, I say all 7 of them are very good companies, very well managed, different strategies, all with good track records. And so I think the industry has done well over a period of time. I think we have some unique challenges here. If you think about the last 25 to 30 years, we've had a period of pretty much declining interest rates. And, back when we went public, our initial financing was 5 to 7 year mortgage debt, which was somewhere around 7% back then. And guess what? We're close to that now. So, so we're going to be in a world where cap rates they have moved up and they're moving up again, necessitated by the financial markets, but they're still a bit lower than maybe they ordinarily would because rent growth continues on. The impact of inflation, a more inflationary period is, incomes can grow faster, so rents can grow faster without pushing affordability. And so that part is good for now, although, the Fed is pretty much dedicated, it seems, to slowing the economy down, which could change that whole scenario. So I'd say the industry is in a state of limited visibility for the foreseeable future, and there's some new challenges ahead of us.
Yeah, it sort of reminds me. You and I have been in the industry long enough that we've gone through. I personally have been through 3 recessions, and maybe this 4th one is coming, maybe not. But the recessions they've been spread out more and more over time. And so one of the things that I know on the operating side has been true is that by the time you hit a recession, most of your employees are new enough to the industry, and new enough could be 8, 9, 10 years in the industry, never having gone through a recession. And so I'm also kind of curious your perspective both on how you help the operation side, and then this time I think that deal guys have been used to almost free money for so long that I imagine that same thing will apply to that side. I'm sort of curious your thoughts, because you obviously at Essex do development, do acquisition, and of course operations.
Yeah, it's interesting, and I think there are some regional variances here. But on the operating side, we went through a period in the pandemic where interest rates were at I think there are 80-year lows or something like that, or almost all-time lows. None of us have ever seen that in our careers, and as a result of that, property values spiked up, and everyone was hitting their stock price all-time highs, and all kinds of good things happened. And so to be in this scenario represents a dramatic about face in terms of conditions. And whenever you have that quick of turnaround and as dramatic as it is, there will be there will be casualties along the way.
Yes.
And I think we're just starting to see that now, and really driven by this exceptional activities of the Fed going in one
Yeah.
direction, making money so cheap, and then flipping around in completely opposite fashion now with
Yeah.
the specter of inflation. But so yes, I think it's a very unusual time, and we haven't been through it, and our operating teams haven't been through it. Although, I think that on operations, we've learned to simplify things to a certain extent. Hey, let's just focus on, availability 30 days out, and let's make good decisions about that. Let's not try to predict what the market's going to do. We understand seasonal patterns. We understand, how this works. So let's not assume that we know more than the market knows. Let's just keep in touch with the market and move quickly as needed to, keep the company operations going. So I think that part of it has gotten better over time.
Yeah, no, that's music to my ears, because I remember in the early days of revenue management, with LRO, and people would always go, well, you mean it doesn't include like the unemployment? And my question was always, well, if I told you that unemployment was going to spike or unemployment was going to drop 9 months from now, what would that cause you to change in your pricing decision today? The answer, of course, is nothing, because that's today. 6, 7 months from now, I might care, but
Exactly.
the industry's full of deal guys who are used to making 5, 10, 20-year decisions, and pricing is a much shorter decision. So that was music to my ears.
Well, I give you great credit for your part in creating all those things, but I think you got that very right, and I think it was transformative for the apartment companies that were using it. But yes, we tend to overthink a lot of these things. We use data at every part of our company, and there are some pieces of it that are available commercially, and other parts that we have to build on our own. So we start with sort of fundamental supply demand information, like the longer view of what markets are doing, and try to distill an estimate of job growth based on historical patterns, what we see going forward. Turning that into how many households are being formed, and then what does the supply side look like. So we take a sort of long view on a lot of those things, but when it comes down to pricing apartments, you're exactly right. And all that matters is how many people are coming in the door and how many units you have available, and going out a little ways.
Yeah, so it was interesting the way you were describing the whipsaw. I think of something that I hadn't thought of before, right? And that is, for a long time, the publicly traded REITs were a bit at a disadvantage to the privates. In fact, that's why a lot of ones have gone private, or as you mentioned, the consolidation, because the private REITs, or the private, even non-REITs, will take more risk on leverage and things like that. I'm sort of curious. Literally, I never thought of this until you were talking about it. I'm curious if you see the potential for opportunities on these publicly traded REITs, like Essex, where you have a lower leverage than the private guys. And so you're much better positioned to weather a storm around big changes in cap rates if it happens.
Well, I definitely agree that's the case. We are, most of us are 25% leverage, whereas the private companies can be 60% leveraged. And but then there's another part of it, though, that is actually somewhat of a drawback, because if you would have asked me going back a long time, what would the relationship between REIT stock prices, apartment REIT stock prices, and private real estate values, what would that look like over time? And I must say, as time has gone on, I think we trade at a discount to our net asset value for long periods of time, and that is an impediment, because we don't have essentially the currency to go out and grow the companies dramatically, except during the times that that equation works in our favor, i.e. the public markets paying more than what the private real estate values are. So there's pluses and minuses, but I agree with you with respect to the very short term, that because the public companies are generally backed by unsecured bond financing that's lower cost, and they don't have a lot of financing, that they are very well positioned now. And actually, there have been a number of articles about some of the private REITs, the large private REITs that are out there, which is a whole nother phenomena. And they're much higher leveraged, and they've done better given that leverage going in the right direction. But it's a different world now.
I've always been. I mean, it's been a while since I was part of a REIT. You know my background from 10 years at Archstone. It always blew my mind. I never quite understood. Again, I'm not on the finance side, but I never understood why we so frequently traded at a discount to the net asset value. I still remember one year where Scott Sellers, he like sold 3 or 4 of our properties, not because we actually needed to sell them, but because he was trying to prove to the street what our NAV really was. I'm not sure that he actually convinced the street to treat us any differently, but I remember that's been a real interesting sort of dilemma for the publicly traded REITs for quite a while.
Well, I think it's gotten worse, and I think largely it's gotten worse because you have index funds that are own such a huge chunk of the public companies, and the impact of index funds is if they have redemptions, they're selling portfolio, they're reducing the size of the index fund, and that's driving price down. And so it's not even necessarily tied to the dynamics. It's more tied to just flows of money given the index funds, and which means that we have very little control over how that's going to look in the future. And the other part is this idea that if you trade at a discount to NAV over long periods of time, how do you manage that? What do you do operationally to manage that? Do you really just go crazy when you actually have some wind to your back with respect to trading at a premium to net asset value? Or how do you manage to that? Share buybacks when you get at steep discounts? There are implications to that we all have to figure out, because it's a reality. And again, it's a reality most of the time. It's not like what we'd hope, which, okay, we're going to be at a discount to NAV 20% of the time. It's a lot more than that.
Yeah. Well, I'll tell you what, in the spirit of the whipsawing of interest rates, let's whipsaw topics, and we'll leave the detailed business for a moment and kind of get onto the personal side. So, you recently announced your upcoming retirement, but let's go a little bit earlier in your career. So how did you start? How did you end up in rental housing?
Don, repeat that last question there. You broke up a little bit. How did I?
Oh, I said. I was saying, let's go a little bit earlier than your upcoming retirement, and how did you start in the industry?
Oh, yes. Well, I was very fortunate, actually. I was in the venture capital world in the early 80s, really bad timing there. And I realized that, timing in life is super important, and being at the right place at the right time. And so I made the decision to leave the venture capital world, and I was looking for a bigger industry, because, the venture capital industry at that time was so boutique-ish. Weren't a lot of jobs there, and similar actually to real estate. When things are down, it's down everywhere. So thought, what, for career safety, I need to be in a bigger industry. And I think it was my first or second interview after making that decision that I got an interview with Marcus Millichap, and it's turned out to be just the greatest move of my life. I guess I would say it's the best decision of my life, except I have to think about my wife. If she were here, I would say it was the second best decision of my life.
There you go.
And so it's just been a fantastic career, amazing people throughout that period of time. Essex was a subsidiary of Marcus Millichap, and so we spun it out as an IPO in 1994. And I think I was a lot of luck and being in the right place at the right time, and just picking the right opportunity.
Yeah, it is a fascinating industry. I refer to it as a flypaper industry. Like, people come from outside into it, myself included, and you just get stuck. I can't imagine any other industry. As you say, the people are so great. And I actually have thought about this. I think the fragmentation of our industry allows people to be great, right? If you think about a really concentrated industry where people are so competitive, they really can't be nice to each other. But I remember my days at Archstone. We had buildings that competed with Essex, but not enough. We competed with so many other people that we could still share good ideas at a conference, or really actually like each other, instead of feel like we had to always fight each other. It's really a fascinating industry.
No, I agree. You know, we get together, we have a meeting in connection with the Citigroup conference every year with all the
Mhm.
apartment CEOs, which is always pretty fascinating. But I will tell you, they're a very competitive group as well.
Oh, no,
So as
I don't
nice
mean no. Yeah,
as nice as we are, and as much as we respect one another,
yeah.
there's no doubt we're all after the
Oh,
top prize.
absolutely. But still, I grew up in the travel industry where, United versus American, back in the 80s and 90s. And we really can be, you really can be friendly with your competitor as opposed to, just, sort of villainize them. Anyway,
Yes,
so let's
it's
go back in that.
it's definitely collegial. There's no question
Yeah,
about that.
collegial. That's exactly the word. Yes, I really enjoy that. So let's talk about as you grew that career. I think you've talked about them before, but share with our audience sort of who were your most influential professional mentors, and what did you get from them?
Well, hey, I knocked on the right door, and George Marcus and Keith Gerke are my two main mentors, and they're such brilliant people. And I attributed much to just being in the right place at the right time. But from the very beginning, it was about strategy, and how do we develop the strategy in a thoughtful way? How do we adapt quickly? We worked hard. I think about that period of time, which was mid '80s. Half the business people were out having two martini lunches and that type of thing, and we were not anything like that. This was a very serious organization, and people worked hard, and they were smart. There were really smart people around me everywhere I went, and so I was just lucky to find the right place.
Yeah,
so.
no, well, I mean, to have some of that Marcus and Millichap DNA is obviously an advantage. They continue to be, such a great company, such a serious company as well. So now let's turn towards the latter part. Right after such a long and successful career, how did you come about deciding that it was time to pass the torch? A lot of people hang on for a long, long time.
Yeah, that part of it is, I guess there are different pieces. I mean, it's really driven by the people that are coming up through the organization. You can have the CEO that stays indefinitely, and many of us have much longer career expectations. My reality is that I've worked really hard at this job, and I work differently probably than most CEOs. I have a hard time just letting go of the responsibility, the decisions, and that type of thing. I'm talking about sleepless nights and that's those things. And the last couple of years, amid COVID, have been definitely the most challenging of my career. But in terms of timing, it's really driven by, okay, we have a succession plan. We've always had a succession plan. They run for 3 or 4 years typically, through the organization. And when your successor gets to a point that they're ready to succeed you, there's little choice in the matter. What are you going to do? You're going to say, no, I changed my mind. I'm going to stay. Well, I would never do that. So it's parts driven by, I'm 65 years old now, so that's a factor. You have to retire at some point in time. And part that, Angela is ready to be CEO, in my opinion, but also the board's opinion. And so to not retire would be to hang on too long and to impact potentially Angela's career and potentially the company going forward. So not something I'm gonna do. Having said that, I am hoping that I can stay and add value in some other capacity at Angela's direction. So I'm happy with that. But in my view, this is just like, well, of course, we're at the end of the succession plan and she's ready. And so it's time to step aside. There's no really choice here.
So Angela does start as CEO April 1st. Two-part question. What is the thing that you're passing on to Angela that you're most proud of? And what's the biggest challenge that she's going to have to pick up as well?
Well, I think we pass along a great track record until recently, I would say. I mean, the COVID period has affected coastal markets to a much greater extent than the middle of the country, and
Right.
and so sort of the DNA going back to how we approach the business. Again, we start with supply and demand for apartments. We try to quantify what that looks like over the next 3 or 4 years. Then we
Mhm.
estimate what rent growth will do over that period of time. Then we rank our markets from top to
Yep.
bottom. And so that that process, which is very much a data-driven process, and which I know you will love
Mhm.
that comment,
Yep.
but it is, and what you're trying to do, it's not perfect, but what you're trying to do is just look at the forces that drive apartment demand and supply factors, and it gives you such great insight into the longer term. Now, the public
Mhm.
markets are all about the short term. There's no single model that goes beyond 2023, 2024 probably. And we have to think in much broader terms, much longer terms, because
Mhm.
the frictional costs of moving in and out of real estate, especially in California with transfer taxes, Prop 13, et cetera, very substantial. So you shouldn't just move from market to market. I don't see how that's possible. Now, for the stock investors, obviously it is possible because the frictional costs are much lower.
Right.
But in terms of running the company and that basic strategy, which it's evolved over 30 years, but it isn't fundamentally different from what we
Mhm.
did and even in the 80s
Yeah.
and 90s, where the data sources are a lot better, but we still approach the business the same way. And I think
Mhm.
that DNA Angela accepts. The track record
Yeah.
continues to be good, and again, this COVID period has been a real challenge for us, but I think we get back on track. In my experience in these recessionary periods, when you fall, the farther you fall, the more time it takes to come back. And so I think
Mhm.
we're definitely on our way back. And
Yeah.
and in fact, if I look at core FFO per share, our primary operating metric,
Mhm.
we're now pretty well above where we were in 2019. So
Yeah. Yeah.
that's good, but we still have a long way to go. Our number
Yeah.
one market is typically Northern California. It's interesting how we approach the business. We want to be in the markets that grow the fastest in terms of
Right.
rent growth over long periods of time. That's Northern California and Seattle generally,
Yeah.
and we use Southern California sort of as the broader economic base. It's not as volatile.
Mhm.
And
Yeah.
so right now, Southern California has dramatically outperformed Northern Cal and Seattle, but I suspect that won't continue for the longer term.
Yeah, I was going to say, I mean, the sort of cynicism of what is it? I can give you great performance every other year. The whole denominator thing, and
Yeah. Yeah.
it. I do like what I do like about the REITs and the way, as you say, I mean, Equity, Avalon, yourselves, Camden, the ones that have been around for a long, long time, they do, even though they're publicly traded companies, they do seem to take a longer term view. And to your point, okay, NorCal might be in a little trouble because of what happened with COVID, but I wouldn't bet against New York on the east, and I wouldn't bet against San Francisco on a 5, 7, 10-year run. So totally agree with you.
I agree with you, although I will say,
Mhm.
the political structures in these cities have got to, I think, favor the people that go to work every day and pay their taxes, as opposed to some of the crime issues and other things are
Yeah.
a notable thing. Now, our portfolio is really not in the cities themselves. We're more in the suburbs surrounding the areas. I'd say the high quality suburbs where people want to
Right.
live is where we concentrate our portfolio, and so we're isolated or protected from some of the really difficult city
Yeah, I think
centers. But
I think I mean the biggest challenge obviously is rent control, where it's it's easy for a politician to look like they're helping. Obviously, as you and I know, you don't solve a demand supply imbalance by putting a price control in place. You solve it through increasing supply, and that's really hard in California.
Well, yeah, that is a key point, and whenever the regulation comes up, and I agree with you, sometimes it's gone too far.
Mhm.
California has a statewide rent control, which actually is pretty moderate. I think it
Yeah.
caps rents for certain properties at CPI plus 5, max of 10. Now, at that level,
Right.
I don't think it really has a huge impact on supply. But in the areas that that have more difficult rent control ordinances, it definitely does. But what I tell people is, yes, I agree with you that regulation is an issue in California, but keep in mind, it's all that regulation that makes it so difficult to build here. So you end up with less supply. And I do think that, at the end of the day, supply is sort of the killer to the industry. You need to avoid it, almost at all costs. So there is a flip side even to the regulation part of it. Did I lose you? Donald? Oh, no.
Oh, were you able to hear me?
I just got you back right now. I don't know
sorry. Yeah, we're having a little bit of internet issues today. I was saying we talked a lot about how you're a data-driven culture, data-driven, all the data-driven processes. How did you go about championing that data-driven culture? Like, what advice would you give to people who want to champion a data-driven culture? And what do you see as the biggest challenge for data and data flow in our industry?
Yeah, it's something that fortunately I think the George Marcus, Keith Gerke, et cetera, they're very focused on this from the very beginning. Now the data sources have definitely improved. There's a lot more data, and that can be both bad and good because some of the data is not all that high quality. I look at some of the supply data that's out there is more challenged, but there's a ton of data out there, and if you can figure out how to use it effectively, I think it's going to have a dramatic impact. And as I think about things, there are certain things that have changed in the industry. So let's look at the impact of hybrid, for example, or work from home. People are going to have more choice on where to live, and for example, how far from the office. If I only have to go to the office 2 days a week, what does that mean for my commute, and what will happen out there? What are these migration patterns? In the early pandemic, California was shut down, and literally, if you're a restaurant worker or in the travel industries or personal services, you're shut down completely, and you don't have a huge bank account. These are not people that make a lot of money. So what are you going to do? Well, you're going to leave, right? So you have this mass exodus to California, really driven by those lockdowns. And so now we're in this next phase, which is, well, I wonder how many of these people are coming back. So I think one of the real challenges right now is the migration data. And you have a lot of the media that focuses on U-Haul data and USPS data. Well, there are big problems with both of those. USPS, to the extent you're a college student or you've been living with your parents, you're probably not going to fill out a change of address form, so you're going to miss that. U-Haul is the lowest rung of movement data. So trying to figure out what's really happening with all the inherent limitations on the data is a challenge. And we continue to work at it, and we'll figure it out. We know our own data. We know where people are coming from and where they're going to. So that's definitely helpful. But we have a sort of a master thesis on hey, we know we lose people when they approach retirement. They go to other Western markets that are cheaper, have cheaper housing prices, and we know we get relatively high income and more educated workers from the big, more expensive East Coast metros and Midwest Chicago too. So that's the normal flow. But how have those patterns just been disrupted here? And what does that mean going forward? It's still, somewhat murky in terms of figuring that out.
So one last question before our final little fun set. So what is one thing that 2022 Michael Schall knows that you wish you could have taught 1986 Michael Schall when you first came into rental housing?
Yeah, I would go back to the REIT decision, go public decision, because I'm shocked, as I mentioned earlier, I'm shocked that we traded such a discount to net asset value, and I think it has pretty dramatic implications. And you look at some of the private REITs out there, and some of the other, organizations that are out there. And I wish I would have known that back then. REIT, for example, which have been so successful, and some of the other areas which are using more leverage, probably riskier, but they've been able to capture a big share of the flow of funds that you hope that would have gone into the apartment REITs, for example, or into the REIT industry. Just hasn't worked out that way.
Totally get it. No, that's a really interesting perspective. Okay, so we're done with the heavy lifting. We always like to end these interviews with a little bit of fun, rapid fire kind of James Lipton style Q&A. So the only rule is don't think too hard. 7 quick. I don't do 10. I do quick 7 ones. Okay. First one. What book has influenced you the most?
Oh my gosh. I'm not remembering its title, but it's about corporate life cycles and how they change over time. Bureaucrats to Barbarians.
Oh, cool. I like that.
It's a cool
I have
book.
not read that book. I'm going to have to look that one up. What's your favorite time of day?
I love the evening time. Favorite time of day.
What's your favorite app?
I'm not really great with apps, so I probably spend most of my time on either Seeking Alpha or maybe even Prime Music.
There you go. What's your pet peeve?
Oh God, I hope I don't have too many horrible pet peeves. I'd say organization and absence of clutter.
What's your spirit animal? And it's my marketing person who always makes me ask that one.
I've never thought. I'm not an animal person generally, but I'll take a bird.
Bird. I like that.
Yeah.
I like that. If you had to pick one food to eat forever, what would you eat?
I would eat. That's a great question too. Interesting. I would eat salmon.
Salmon. Oh, there you go. And what is your go-to for a good laugh?
I guess I would have to say the Saturday Night Live type of shows.
Excellent. Well, thanks so much for sharing your insights with us today, Mike. Just briefly, where can anybody interested learn a little more about Essex or about you?
Hey, reach out if anyone has any questions, or I can follow up in any way. So I think you covered it nicely.
Excellent. Well, thanks so much, Mike. Really appreciate you joining me, and had a lot of fun getting to know you a little bit more, not just about the business, but also personally. Thanks, Mike.
Yeah, Donald. I hope our paths cross soon. Take care. Thanks a lot.